Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. As mentioned in my daily financial news, I have an extra special guest for you. Soon to be a returning guest, but more on that later. Let's welcome a good friend of mine, somebody I've known for multiple decades now. Yes, I do have friends, folks. I actually have friends. Let's welcome Dan Bird to the channel. How you doing, Dan?
I'm doing great, but let's not get over enthusiastic about the friends part.
Ouch. Starting early, I see.
Just kidding.
I know. I can take it. You're always good with those one-liners. Hey, so the reason I've asked you to come to the channel is A, you're retired now, and B, you bring an expertise that I don't have, and I frankly care not to have, and that is around trading stocks. You have been deep into the stock market for a long time now. I'll let you cover that in a minute. But one of the things that I have been missing on my channel, which is about investing, mainly real estate, is stocks. So I want to appreciate you for being a part of this, and looks like to be a weekly contributor going forward. So Dan, thank you very much. What do you want the audience to know about you?
Yeah, so as you said, I was in technology sales along with you for many, many years. Mm-hmm. Did very well, very successful with that. And a lot of that time spent there was not in buying fancy new cars or big new houses or any of that kind of stuff.
Right.
It was socking it away and building what I call my war chest to be able to do what I'm doing now, which is trading stocks, trading my own portfolio, basically.
Right.
And I am what's called a technical trader.
Mm-hmm.
So that's using charts to understand entries and exits.
Mm-hmm.
That has to also go along with fundamentals.
Right.
So it's important to understand what the company does, whether they're successful, what industry groups they're in. Mm-hmm. And then at a much higher level, and we'll talk about all of this in a second, but a much higher level is understand what the market itself is doing.
Gotcha.
What's the market doing? What are the sectors doing? Where is money rotating to or out of? Because that will have an effect on whatever stocks you decide to buy.
Yeah. So again, so a technical trader, again, somebody using charts. You started doing this really deep research how long ago?
20 years ago, probably. Yeah. Probably about the time that you got stopped out of the market.
Yeah, exactly. Yeah, right after I lost.
About the time I started.
Yeah. So yeah, this is going to be a fun conversation. Again, you've been doing this a long time, ever since we were working together. I'd be talking real estate, you'd be talking stocks. So it was always fun to listen to what you were doing. So I don't know where you want to take this. You want to take control of the computer and kind of show the folks some things that you look at as you kind of get into this?
Yeah, I have some slides, and can you give me access to the whole desktop?
I did, I think.
Okay, good.
I think you have control.
In that case, let me set up one thing here. Hold on.
Yeah, I think you should be able to share whatever you would like.
Right. Good. Okay, so I'm going to show a few slides to start it off, to set the stage.
Please do.
Talk about what technical trading means. We'll talk about the markets at a high level, where they're at, where they're headed. And then we can talk about what my process, some part of my process, what that looks like.
Yep.
And then I also do a newsletter every week, which is free. It's just something that I do for fun. It helps me in my research. I usually do my research on Saturday mornings.
Awesome.
Because the market's closed, I can see what it did. And as part of that research, the newsletter actually helps me with that research.
Yeah,
I do it more for myself, but a lot of other people like reading it. So
yeah, I have found, again, I'm on your mailing list. I have found the simple activity of having that kind of repetitive nature helps you stay engaged. It helps you keep watching. So yeah, I appreciate the newsletters for you, but yeah, it's a lot of value in there. So yeah.
Yeah, good. Hey, before I start, I noticed you always wear a baseball cap.
I do.
So let me put my baseball cap on.
Okay.
You can see this.
Oh yeah. Oh, there it is. Yeah. Yeah, I like it.
I'll show you this in a second.
Okay. That's funny.
All right, I'm going to share my desktop.
There we go. Okay.
Let's see. What are you seeing? Are you seeing the desktop right now?
I'm seeing a desktop. Yeah, it's a desert with some teepees or something on it.
Okay.
There we go. So it's not a Ponzi scheme.
It is not a Ponzi scheme.
Are we talking about the stock market?
It's a buy the frickin' dip scheme.
Ah, that's your hat. Yes.
That's my hat. You've heard all these terms before, I'm sure.
Yeah.
Buy the frickin' dip.
Yeah.
Or hodl.
Yeah. HODL. Yes. That's a
Right.
big thing lately. Yeah. Diamond hands. Yeah.
Diamond hands. Hold forever, which is the stupidest thing I've ever heard.
I agree. Hold forever is a recipe for disaster. But anyways. Yeah.
It
Okay.
is. Absolutely. So that's my hat right there. I have
I
a
like
t-shirt. I have a t-shirt with these two things on it too.
That is hilarious. Okay.
Yeah. All right. So first I want to talk about charts a little bit.
Mhm.
And to start it off, just to give you a sense that charts can tell a story.
Yeah.
Here's a story using charts.
Yeah.
So the red line is bad reviews of Yankee Candles on Amazon saying they don't have any scent. And the blue one is daily COVID cases in the US.
Oh, yes. Non-correlated charts, but they do tell a story. Yes.
It does tell a story. You can correlate them that way.
So I guess when COVID cases go up, people can't smell candles. That's what
Exactly. That's the point.
that's the point. Yes.
Yeah. So they complain. They go online and they complain about it not being able to smell the candle.
So it's actually a leading indicator because the red line moves up first and then the case counts
That's
will go
right.
up later. Oh, there we
Exactly
go.
right.
We should be watching.
We should send this to Fauci.
Yeah, Fauci, go watch Amazon's ratings of no scent on their candles because it is an early indicator.
Right.
I think that is hilarious. Oh, thank you. Thank you for making me laugh this morning.
All right. So let me start off by doing a very high level view of the market.
Okay.
And this is important.
So just to level set everyone, the bottom of this is years, right? That's
the bottom. Yeah.
1932, 1934.
Is that it actually starts? Yeah, it's right here. It actually
Yeah.
starts just before the Depression.
Yep. Yeah, I'm just trying to orient myself.
29 is right there.
Gotcha.
And it goes
Okay.
all the way till basically today. All right.
Yep, I'm with you.
And this shows you the secular bull markets and the secular bear markets. Now, a secular bull market or bear market is different from a cyclical bull market. And
Okay.
I'll show you what that means in a second. But you can see here, there was a period for this bear market from 1929 to 1950, basically,
Yeah.
when it was in a bear market,
So 20 years-ish.
20 years. right?
Okay.
And then it broke out. So it broke out of the high. So essentially the bear market is defined as not just stocks continuing to go down, but stocks not recovering their previous high.
Yeah, to the past peak. Okay. Got it.
Right. And I have another chart after this that will really bring this home.
Okay.
So then it breaks out and it goes into a secular bull market from 1950 to 1970. So about 18 years roughly.
Okay. Yep.
All right.
I see
And
that.
then we had another secular bear from about 69. This is the 70s inflation period,
Yeah.
right? Till about 81.
Okay.
And then it broke out again. And we had a very long secular bull market, again, from 81 until basically 2001.
Yep. I remember
20
that period.
years.
Yep.
20-year secular bull market. You're starting to see a trend here.
Yes.
18 years, 20 years. 2001 was the dot-com crash. This is where you got out.
Yes. I remember.
Actually-
I think I
actually,
know the
maybe
exact
right
peak.
here.
Yeah, I probably got out there. Yeah. But anyways, yeah. That's
All
fine.
right. So even though it came back up in the early 2000s, and then it had another crash in 2008, it never recovered its high. It never broke out of its high.
Gotcha.
So the
Okay.
secular bear actually continued and lasted until, depending
Interesting.
on when you want to identify it, it's 2013 is when it broke out above this high.
Interesting. Okay.
2009 is really where it started, but this is where it broke out right there.
Got
And
it.
we are currently in a secular bull market
Okay.
that, remember,
Mhm.
lasts 18 to 20 years.
Okay.
So if you start this at 2013,
Mhm.
we have until 2033.
Got
Got
it.
another 10 years left.
Okay. What are
The
the
secular-
symbols below that chart? XL.
These are the S&P sectors.
Okay.
So
Got it.
since 2013, how
What are
much
they
they
up?
have increased during this bull market.
Understood.
So this is technology right here at the
Mhm.
top.
Mhm.
The technology went up the most, and it usually does because it
Of
has
course.
most of the growth
Yeah.
stocks, and growth stocks do well in bull markets.
Okay.
One thing to point out during this last bull market right here,
Mhm.
can you identify the 1987 crash?
I mean, yeah, I know where to look for it, but yeah, it's that little, yeah.
Right there.
Yep.
In the overall market, on the overall rally,
Yeah.
barely a blip.
Yeah, it recovered that. Well, it actually took a while to get back to that trend line.
It took about till 1990
Yeah.
to break out of that.
Yeah.
And
Okay.
then can you this is a little easier, but can you identify the COVID crash?
Oh yeah. Yeah. That one right there.
Right there.
Mm-hmm.
But again, it never really went below this moving average line.
Yep.
That's a 50. This is a monthly chart.
Right.
This is a 50 month. So that's a 1 year basically moving average.
Okay. All right. I understand your thesis. Yep.
So you can see the secular bull market really didn't break below that 1 year moving average.
Oh, that's a 1 year moving average. Okay.
That's a 1 year moving average. That dark blue one at the bottom.
Got it. Okay.
And this current bull market, other than very briefly
Right.
during the COVID crash.
Before the Fed came in and bailed everybody out. Yep.
Right. Right.
Okay.
All right. So what this is telling us is we are still in a secular bull market. Now, will we have corrections inside of that bull market? Absolutely.
Of course.
We had one here. We had one here. We had one here with COVID. We had a couple here back in 2018. You might remember that one, the end of the year.
That's when the Fed got a little hyper aggressive. Yep, I remember.
Yeah. So there'll always be corrections inside of a bull, but in general, and that's why when this particular correction happened for COVID, even though I got out, I went to cash at the top of this before it happened.
Yep.
For other reasons, I didn't really know COVID was coming.
Right.
But really, it was for looking at the charts. I got out.
Nice.
But I didn't think it was going to continue because I knew we were in the secular bull market. And we have anywhere from 8 to 10 years left.
Well, that's interesting, right? Because again, right. So for me, right, again, you do this a lot more than me. I don't even bother with stocks, which I think we're going to fix here. But the thing that you just said that, I don't know, goes against, it rubs me the wrong way a little bit, is that recovery was because the Fed came in, right? It's back to your Amazon candle analogy.
Yeah.
It looks good on a chart now, but the Fed, again, maybe the Fed is always going to be the Fed put, but it's hard for a chart to assume that, right?
Well, it doesn't matter.
Oh, it doesn't
really matter.
No. All right.
If you study charts and you understand charts, the reasons behind what the chart does isn't really that important.
Oh, okay. All right.
The chart is telling you what price is doing, and price is the most important thing.
Got it. Okay.
So it's going to tell you, and there could be all kinds of reasons behind every one of these.
Oh, for sure.
You know, the 2018 one was because the Fed got too aggressive.
Correct.
Right. And they were predicting, well, they did 2 rate hikes in 2018.
They did 2 right at the end
they
of the
were
year.
supposed to do another one, which they canceled.
Yep.
They said they were going to do 3 in the next year, and they did not.
Yeah, you're right. Okay.
Right? They just said again, we're going to do 3 in 22.
You're right.
I would be surprised if they even get past 2.
Interesting. Okay.
Because we are in a secular bull market, just like in 2018.
So because we're in a secular bull market, you think they don't do more than 2? Why?
Well, I don't know. I don't know what they're going to do. One thing that's important to bring up right in the beginning is I don't make predictions.
Oh, of course. Yeah.
I do not know what the market's going to do.
Yeah, you're just looking. Yeah. Okay. I got you.
Right. I mean, yeah, I'm saying that a secular bull market typically lasts 18 to 20 years because it has before. But it could crash and go all the way back down below this.
Okay. I got you.
It could. Anything could happen.
Yeah, for sure. Yeah.
So
okay.
These are just probabilities.
Understood.
Basically. Think of it that way. That's what charts really tell you what the probabilities are.
I like it. Okay. All right.
All right. Then the next one is sort of the same, but it kind of shows you
the everything bubble. I love it. Sorry.
The period of 0 returns.
So
this is kind of highlights what I said before, that you've got a bear market, but inside of those bears, you're going to have bull rallies.
Sure.
Back here in 2001, to 2013, the market rallied pretty nicely
Mm-hmm.
up here to 2008. Between 2003, 2008, it rallied really nicely,
Yeah.
but it never really made it back to the high. So 13 years of zero returns, 26 years of zero returns, 52 years of zero returns. So back to the HODL conversation we had in the beginning.
Yeah.
And when financial planners tell you, just put your money in there, don't touch it, just let it ride. Don't
Yeah,
worry if the market goes
that
down.
is the thing that annoys me the most about
Right.
this generation of traders, right? Or actually, no, I don't want to say traders. I want to say investors.
Yeah, let's define those terms. I heard you on one of yours do a pretty good job of that.
Oh, good.
There are three of them. There are gamblers.
Yes. Traders and investors.
Traders and investors.
Yeah.
And the gamblers are the ones that are on Reddit.
Yes.
And Wall Street Beats, and they listen to people online, or they listen to their buddy up the street, and
they're using leverage.
They buy a stock because somebody else told them.
Yes, exactly. Those are gamblers, no question.
Right. Traders are ones that are not necessarily in it for the long term, but they ride trends.
Correct. And that's where I would place you.
That's where I am. Right.
Yes.
They identify a trend, and then they ride the trend until the trend changes.
Correct. I think that's very well said. Yes.
And then investors are people that buy good stocks and good companies with good management and hold it forever.
With the intention of holding it forever. Correct.
The Warren Buffetts.
Yes, exactly. They're buying little coupons or percentages of the company's future income. Correct.
Right. Right. And so they don't care about all this noise.
No, they don't even look, or look very rarely.
But they do care about when they get in. So
correct.
This is my point with financial planners, that they say, buy it and just hold it.
Mm-hmm.
Well, that's fine in general. If you were
long enough time horizon, yeah.
If you were born in 1928, like my dad was,
mm-hmm.
and he bought there and held it, I mean, he had a pretty painful period after the 29 crash.
Mm-hmm.
But if he was still holding, doing really well.
Yeah.
The point is that might be a good strategy, but it really depends on when you buy.
Well, that's where I was going to go with this chart, because I think something we are learning about this pandemic and the Fed's response is a lot of things have been accelerated. What normally would take 5 years took 2 years. And I think there's a lot of people doing this HODL or diamond hand nonsense that are saying it now because they're underwater, not realizing that, again, looking at my time horizon, you could have been frozen for 13 years. I mean, is that really what you want to do?
That's right.
And, for most people will not hold for 13 years. Most of you are not Kathy Wood with this joke of a 5-year period. Yeah.
Right. Most people will sell right here.
Oh, of course. Or certainly the next time it got back up halfway and then it fell again.
We'll talk about that. We talked about doing a session on the psychology of the market.
Mm-hmm.
We'll talk about that when we do that session.
Awesome.
About that whole psychology.
Perfect.
All right. But anyway, again, charts tell a story. This is inflation, something that's been on the, everybody's been talking about this lately,
mm-hmm.
including you on your channel.
Oh, yeah.
This is kind of putting inflation correlated with interest rates.
Oh, that's interesting.
And you can see in 1980, in the 70s, when inflation was screaming higher, interest rates went much higher. Inflation came down. Mm-hmm. Interest rates came down. Right now, interest rates are still basically close to zero.
Yeah, basically zip. Yep.
And inflation is screaming higher.
Yeah. And this is probably CPI, I'm guessing, based on the way it's at 6%.
This is CPI, and actually this is a little outdated because it's actually higher than
it's 6.8 now. Yeah.
Yeah, it's actually higher than this 90 peak right here.
Correct. It's going back to.
All right. So again, here's the financial crisis.
Mm-hmm.
Here's the pandemic. Interest rates. This is again back to what you were saying.
Basically, the market freaks out, the Fed bails it out. That's what this says.
That's right. And unfortunately, the Fed keeps it bailed out for too long.
Oh, I agree with that 1,000%. The Fed stays engaged way too long. Yes.
Right, which is what's happening now.
Yes.
And then one more on this particular topic. Actually, I have another one that's pretty interesting, but this shows the consumer price index. By the way, I had the little boxes with our pictures in it.
Yeah.
In front of me. I put it on my other screen.
That's funny.
All right, so you can see the last 3 recessions in gray.
Oh, got it. Okay, yep.
The black line is consumer price index, CPI.
Oh, wow.
The red line is PPI, producer price index.
Interesting.
And notice right here where these cross,
Interesting.
producer prices went down where consumer prices did not. They continued up. So what does that mean? That means companies were making more profits.
Well, it could mean that. It also could mean they're eating margin.
Well, producer price, yeah, that's right. They're not increasing it.
Yeah, they're not increasing, right? It could be efficiencies, it could be lots of things, but yeah.
Actually, the price of the consumer continued to go up.
Right.
So
no, I see what you're saying. Yeah,
so what producers were charging either stayed the same or went up slightly.
Correct. You're right. Yes.
But what the producers were paying for their materials went down.
Got it. No, I see what you're saying.
So that improved their profit margin.
Damn greedy companies making all that money.
Yeah, well, it all comes back eventually, right?
Yeah. Yeah, I think PPI just this last period was above CPI for the first time in a while.
That's right. Yeah.
Yeah.
PPI went above CPI.
Yeah.
And that's going to eventually, move CPI prices up as well.
I agree.
So between these two blue lines, this is where companies were making more profits.
Oh, that's interesting.
And the one at the bottom is the S&P, and you can see the S&P went up.
More, yeah. So that's more profit. Doesn't actually mean a higher PE, right? It just means more bottom line.
That's right.
Potentially. Yeah.
Right.
Okay.
Now the purple line, I threw this in there based on a suggestion. I posted this actually on LinkedIn. And one of the guys I work with at Splunk, Dan Holmes, I don't know if you work with him there.
I know the name. Yeah.
He suggested I include the price of oil. So I put the price of oil in there too to see how that correlated. And interestingly, the producer price index went down in correlation with the price of oil.
Yeah. Oil, as we learned in the 70s, oil is a part of a lot of stuff.
Right.
Yeah.
It is now.
Correct.
It won't be soon.
Yeah.
All right. And then this bottom one is interesting as well. This is the 10-year and the 2-year treasuries.
Okay.
All right. So if inflation goes up, then treasuries usually go up.
Yeah.
But the important thing here is the relationship between these two. And what you can see
inversion,
right here, there's a rate inversion where the 2-year treasury was selling for more than the 10-year.
That was 06. Okay. Yeah. Makes sense.
And usually an inversion, again, I'm not going to say this all the time, but usually happens about 6 to 9 months before a recession. Yeah,
I think that's predicted 6 of the last 8 recessions or something. It's one of the better indicators, but nothing's perfect. But yeah, yield inversion. Yeah.
So that shows that. I've got one more that really brings us home even better.
Okay.
And this is over the last 2 years, roughly, just before COVID.
Okay.
And what I'm suggesting with this chart is that the market doesn't really think inflation is a concern
today.
Yes, inflation is going up, but the market doesn't see it as a concern.
That's interesting. And now I see why you got out. You talked about earlier, you got out early. It's because of that yield inversion?
The yield inversion was one of the reasons.
Okay.
The other one was what's called a negative diversion, which I'll talk about.
Yeah, lower tops and all that. Yep.
Yeah, where the underlying fundamentals of the market start to go down even as the market continues to go up.
Would that be something like, hey, the top 5 stocks are going up, but the underlying, the other 495 stocks are going down kind of thing?
That's sort of part of it, but it's really more of the relative strength of the market.
Cool.
So relative strength is the underlying component that tells you if the market is running out of steam, basically.
All right. Well,
so if the underlying relative strength starts to go down and the market continues to go up, that means the market is going higher on slower and slower momentum.
Got it. Okay.
And that usually is a result of just a few stocks driving the market higher, even as the other stocks fall off.
I have a kind of left field question, but I'm going to ask it here anyway. How many hours a day do you spend looking at, I don't know if it's a day or a week, whatever the right answer is. Do you spend kind of absorbing what's happened in the last day or week on these charts? Is this like a daily activity?
I'll show you what my process is in a second.
All
but I usually do it in the morning around 8 o'clock.
Okay.
And it only takes me 15 minutes.
So daily
look at it.
discipline, 20 minutes a day, roughly.
Right. Yeah,
Cool.
and one comment I'll make about charts and
Uh-huh.
understanding charts, and I've used this analogy in the past.
Mhm.
Charts is sort of like learning a language.
Ah,
If you want to learn French, right, you study the French words and you make a comparison to the English words.
mhm,
And then when you see those French words put together, you try to convert those to English
mhm.
to understand what the sentence is saying,
Got it.
right?
Mhm.
So that's how you first start learning a language. Eventually, once you immerse yourself in the language, you
Mhm.
stop making the comparisons and you
Right.
just understand.
You just understand. No, I totally agree. It's a similar thing with real estate, right? That's why I always talk about daily, just spend 20 minutes a day. When you're done, move on. So you don't just keep pounding it in, but you do it 45 days, 60 days, 90, it starts to speak to you. So very similar.
Right, exactly.
Okay.
So a couple of things to point out with this one. First of all, here's the recession. There's the yield inversion.
Yep.
Actually, I didn't get bonds and gold on this one, so I'll show you another chart, one I wanted to show in a second. But
Okay.
the key thing here is that the 10-year treasuries continued higher,
Mhm.
even as inflation went higher,
Mhm.
but they never got back to the pre-COVID level,
No, they haven't yet. No.
and they're actually declining, even as inflation is screaming much higher.
Yeah, I'm gonna guess again. You don't make predictions. I think that changes here in the next 30 days, but we shall see.
We're going to see. We're
Yep.
going to see. Well, now you'll notice the 2 year is accelerating faster than the 10-year.
Exactly. I agree.
So at some point, that's going to cause an inversion again.
It could. Yep. Oh yeah, the 10 years down again today. Jesus Christ. Wow.
Right.
Okay. All right.
All right. So the last one more here, and this
Mhm.
one will be near and dear to your heart.
Hmm.
I also posted this one on LinkedIn
Nice.
as well. And this is the Case-Shiller
Oh,
price
yes, I know it well.
put in a chart.
Yeah, exactly. Put in a chart.
And I'm using a 21-day exponential moving average.
Okay.
So the blue shaded area is the 21-day moving average
I'm with you.
of home prices.
Mm-hmm.
This is a daily chart, but it goes back 20 years.
Oh, it's funny. It's right when I started, 2002. Okay.
Okay. So home prices continued higher, and here's the 21-day moving average.
So the largest gap is what you're saying there was 9.2%.
9.2. Largest gap right now is 10.6.
Oh my goodness.
All right.
Interesting. Okay.
A couple of things to point out. This began to flatten here in middle of 2006,
Mm-hmm.
right?
Mm-hmm.
And then it dropped off a cliff in the middle of 07.
Sure, of course.
So that was a clue, in addition to the yield inversion, and in addition to the negative divergence
Yep.
on the charts.
Okay.
This was also a clue that something was going wrong.
Something was amiss. I'm with
Right.
you. Okay.
So then it crossed over right here, basically around November, December of 07. No, I'm sorry. This is
Probably
August.
yeah.
This is
somewhere.
July of 07.
Okay.
Actually, May.
There it
May
is.
of 07. May of 07 was the peak right there.
Okay.
So that would have been the time to sell a house, right when that crossed.
Yep.
May
All right.
of 07.
All
All
right.
right. And then it went below the moving average all the way till here, till May of 2012,
Hmm.
for 5 years. And I posted this on LinkedIn, and one person said, "Oh, well, look at where it is right now. It looks like it's getting ready to crash. Maybe I should just sell my house now
Hmm.
and then wait for the crash and then buy back in." I'm like, yeah, well, you could, but it took 5 years the last time. Oops, sorry.
That's all right. Yeah, that's a long time to wait.
It took 5 years last time. So do
Yeah.
you want to wait 5 years to
Yeah.
get back in?
Yeah, well, there's a couple
Right.
of things on this chart, right? Again, this is something I spend a lot of time in. This is kind of my area, right? This is looking at price as the variable for housing, correct? That's what
Yeah.
this is.
That's right.
There are two other factors, as you know, but I'll put them on the recording for others, right? There's interest rate,
Right.
right? And then there's income.
Yes.
That are equally important. And again, I just talked about on the daily financial news this morning, Barron's, right, which is a financial paper or magazine, I guess, that they
Yeah.
just did some math, and I think I have them here. I will read them for you. So again, 2006, which was what they called the peak. You're calling the peak May of 07. Close enough. Average home was 230 grand. Interest rate was 6.76. Monthly payment was 1196, assuming 20% down. The reason I'm bringing this up is because income for the average family was $4,071 a month. That's a front end ratio of 29.8, call it 30%. That's probably a no answer from a bank. Fast forward to 2021, which you have here on the chart, 353,000. So again, price is way up, parabolic. Interest rates 3.07%, so more than half lower. Again, a 20% down payment, blah, blah, blah. Monthly payment, $1,204. So it's up a whopping $8. However, incomes in 15 years have gone from 4,071 to 5,627. So your front end ratio that was 29.8 is now only 21.4. In fact, housing in 2021, assuming these numbers, is more affordable than 1980s and the 1990s, where the average was 28%. So I think this chart is interesting. It talks price, which I think is the greatest, at least in the real estate world. It's like one of three variables, which the other two are interest rate and wages, unfortunately.
Right. And that is very interesting. I could actually correlate interest rates. I don't think I have something for
my 50-year chart,
income.
My 50-year chart, which I put out, I spent 36 hours putting together, has average family of four income all the way back to 1970.
Right.
I can send it to you. I'll do that.
Yeah. Yeah, that's all certainly very interesting. By the way, this chart does show 2006 as the peak.
Oh, absolutely. Oh, okay, there it is. Yeah, right. You're right. Yeah.
So it actually started to come down in 2007.
Oh, you got the inversion. I got it. All right. So yeah,
that's when it crossed the moving average.
Yeah. Okay. I like this stuff.
All right. I'm going to put, how much time do we have, by the way?
This is just you and me talking. It hopefully provides value. Basically, video number one is you telling us and sharing us what charts you look at. We'll get into psychology and all of that next. We can do another chart if you like, if there's something you think is missing.
Yes. Let me show you this last one, because if anybody wants to get my newsletter, it's free. As I mentioned.
Yeah, you send it out Saturdays, right?
Saturdays or Sundays. I try to do it over the weekend.
Yeah.
I went on a cruise a couple of weeks ago, so I missed a week.
Oh, yeah, folks, I would definitely reach out just to have Dan again, breakingpointtrading@gmail.com. Dan Bird is somebody I've known for multiple decades. Again, he won't put advice. He won't put predictions. He uses this newsletter as a way to collect his thoughts. This is what he's doing. But again, as you will know, I won't talk about stuff I don't know. I don't do stocks, which we'll talk about here in a minute. I don't do charts, but Dan has been doing them for 20 plus years. So I recommend if you have any interest in stocks, sending him a note at breakingpointtrading@gmail.com to get on his mail list. Breakpoint. Oh, I'm sorry. Breakpoint. Read correctly, Zuber.
Breakpointtrading@gmail.com.
Very cool.
And I'm happy to put people on the distribution list. And and if you get tired of it, just send me a note.
Yeah, you'll take them off.
Yeah, it's no big
deal. He's not selling anything. Yeah, go ahead.
No, not selling anything. No. I can't trade for other people's portfolios because I'm not licensed.
Yep.
I've had a few people ask me to do that. I can't do that.
Nope.
This is just for my own portfolio and for my own learning.
Yeah.
This is an excerpt. This is the start of last week's newsletter talking about the Santa Claus rally, which should go through next week, next Tuesday.
Very cool. All right. Any closing thoughts on this?
Let me, let's see. If we have a couple more minutes, I could just go through my daily routine.
Perfect.
And I'll just show a couple of these things.
All right.
So I like to look at a sentiment chart. Now this is busy, but I just want to point out.
So you know what, Dan? Let's do a separate video on your daily routine. I want people to, we'll wrap this up. This is the introduction to Dan Bird. We will shut this one down. If you want to be on his mailing list, let's do that. Video number 2 is going to be his daily routine. Thank you very much, buddy.
You bet.